Hi everyone, I'm Stu Galvis and I sell houses, and this is your June 2026 housing market update for Boulder and Denver. Now, if you've been watching the market waiting for a clear signal, here it is. Supply is shrinking, prices are rising, and the window to act on either side of the transaction is narrowing. This month shows two different markets with the same economic pressure but different responses, and that divergence is where the advantages are. So in this video, I'll cover the housing market and numbers, what they mean for the market, a mortgage rate recap and outlook, and a 30-day market outlook for June to July 2026. But let's start with the numbers at a glance. In the Boulder Metro, total homes for sale are down 16.2%, while new listings are also down a whopping 31.6%. Closed sales are down 19.9%, and units under contract are down 9.5%. The median sale price, however, is up 7.7% higher than this time last year, all the way up to $915,000. Median days on market are down 10.2%, and months of supply, which is a measure of supply versus demand, is down 17% to 3.9 months. The average sale price to list price ratio is up to about 98.2%. In the core Denver Metro, total homes for sale are down 6.2%, while new listings are also down 15.8%, but closed sales and units under contract are both up 1.4% and 4.8% respectively. The median sale price is up 5% to $632,500, and days on market is down about 6.5%, meaning homes are selling faster. Average list price to sale price ratio is hovering right about 98.5%. Here's the punchline. Prices are up in both markets and inventory is down in both markets, even while activity is mixed. Now, here's what's actually happening boots on the ground. The big structural force right now isn't buyer demand, it's seller inaction. New listings in Boulder collapsed down about 32% and Denver dropped about 16%. This is what we call the rate lock-in effect. Homeowners with 3 to 4% mortgages have no incentive to sell into a 6.5% rate world because trading a $2,200 payment for a $3,800 payment on a comparable home is painful. So until rates fall meaningfully, many sellers are going to stay put. Here's the paradox. Volume is down, but prices are up. See, when supply falls faster than demand, prices rise, even with rate headwinds. Here's the Boulder versus Denver split. With the same macro backdrop, we're seeing a different response, and it's based on price point sensitivity. Boulder first. Closed sales are down, but inventory is also down, and the median price rose to $915,000. At those price points, a half-point rate move can add a few $100 to the monthly payment. So some luxury buyers and second home buyers are just sitting out for the moment. But the buyers who are moving are qualified, motivated, and acting quickly. Translation, the listings that sell are selling faster than last year. Now, in Denver, like Boulder, inventory is down, but closed sales and units under contract are actually up, which makes it easier to understand why the median price is up to $632,500. See, at that price point, more buyers can absorb rates and still make the math work. Well-priced, well-prepped homes are still selling fast. So if you're buying in Denver and you're not fully pre-approved before you start, you're already behind. So if you only remember one thing, supply is falling faster than demand, and that's what's propping up those prices. On to a look at mortgage rates. And we're going to connect the dots, but keep it tight. In early March, we saw rates at about 5.75%, which was the low for the year. By late April, they were back up to 6.37%, and that's a fast move. Late May into early June, they're hovering around 6.5%, which is the highest levels we've seen this year. And that swing matters, especially in Boulder. Luxury buyers are rate elastic. They can wait, and many of them are. Denver is more resilient because these are must-move buyers. So, skipping the Fed weeds, here's the implication. 6 to 6.5% is likely the story for the next 6 to 12 months, and for the cliche that's accurate, you marry the house and you date the rate. If the home is right and the math works today, buying now protects your position. If rates improve later, you refinance. If you wait, prices rise again, lower rates may not even actually help you have a lower payment. And here are the bigger implications for buyers. Right now, here's the playbook for Boulder. Under 4 months of supply is still a seller's market by modern standards. Fewer listings are coming and the good ones move quickly. So get fully underwritten, not just pre-qualified, and budget near or even above the list price. Meaningful discounts are not the norm. Know the rate math and know your ceiling. And consider listings that have been sitting 45 days because friction can create leverage. For Denver buyers, under 700 moves fast. Be fully pre-approved and know your numbers cold. Have your lender ready to communicate immediately when your offer goes in. Expect strong competition on the best homes, and remember, if you're using aggressive strategies to win, like gap protection or limited inspection, make sure you understand the risk trade-offs. For sellers, if you're selling, the market's giving you an opportunity, but it's not permission to get sloppy. In Boulder, new listings are down almost a third, which means competition is thin, and that's real leverage. But buyers at over 900K are sophisticated and they're rate aware. Precision pricing wins, and overpricing always costs you equity. Prep and presentation matter in confidence sells, and watch out if rates dip below 6.25. Be show ready before that happens, because at $1 million plus, the buyer pool is smaller, the marketing has to be sharper, and taking advantage of low rates makes a big difference. Now, Denver sellers, closings are up, under contracts are up, buyers are still showing up. And with 15 days average to contract, a properly priced listing should see action fast. But if it sits longer than 21 days, that means you're going to need a pricing conversation. Less competition means more eyeballs, and you can't waste that opportunity with mediocre prepper marketing. And just remember, if you're moving up, think about the price impact carefully. If you have enough equity, a big rate jump may not mean a big jump in payments, but always be clear before you start the process. Now, here's the 30-day outlook, June to July 2026. And remember, this is probability-based, this isn't fortune-telling. For mortgage rates, the base case is 6.3 to 6.5%, at least until mid-July when the CPI comes out. That's the next inflection point. A positive surprise could mean rates dip towards 6.25%, but a negative surprise could push rates up closer to 6.75%. With regard to inventory, we're going to expect listings to be down 15 to 30% below last year because that rate lock-in is structural, it's not seasonal. Prices are likely to hold or maybe even edge a bit higher. Boulder could see a median reach up to 930, 940 if demand holds, while Denver will likely consolidate around 635 to 645. But remember the wild card. If rates dip below 6.25, buyers are going to jump back into the marketplace like crazy, and you're going to see a demand spike, which means more loan applications, more multiple offers, especially in the 550 to 8 range in Denver and anything under 1.1 in Boulder. The bottom line is supply isn't coming to save buyers, and neither are prices. Rates may drift, but the shortage is still here. The buyers who win execute with strategy, and the sellers who win price correctly, prepare thoroughly, and then list when the buyers pop. If this was helpful, please subscribe to the channel and share this video with a friend. I'm Stu Galvis, and I'm a real estate scientist. I've been selling houses between Boulder and Denver since 2005, focusing on smart strategy and doing my best to eliminate the hype. If you want to talk through what any of this means for you, buyer or seller, reach out. No scripts, no pressure, no BS, just solid strategy. Again, I'm Stu Galvis and I sell houses, and this has been your June 2026 housing market update for Boulder and Denver.